Hello, everyone. It's Larry Kotlikoff with Economics Matters. I'm really delighted to have an old friend, Liz Weston, one of the top personal finance journalists in the country and really in the world, uh, with us today to talk about her career and what she's currently up to and what she's thinking about, what she's learned in the. She looks like she just started out, but she's actually been doing this for quite a while, and uh, and she's therefore accumulated a lot of kind of knowledge about people's making decisions, proper decisions, making wrong decisions, but inability to make decisions. Uh, but that's what I see as so damaging, that people just get locked into fear and can't move, and that they're just kind of cutting their own throats when it comes to the personal financial decisions. They retire too early, take Social Security too early, just a whole list of interconnected mistakes. But Liz, welcome, and tell us about where you were born, how many pounds you weighed, and maybe about how you had this fantastic career, where you spent it, and who you wrote for, and just give us a whole Liz Weston.
Let's see, the elevator pitch of Liz Weston. Yeah, I was born in Washington State. I have no idea how many pounds I was, but happy kid. And I went to school in Washington as well. Got my degree in economics and in journalism. And my first job was at the Seattle Times. So I started out as sort of a general all-around journalist. I went up to Alaska. I covered features. I covered the Iditarod, the Exxon Valdez oil spill, had a great time there. Was approaching my 30th birthday and thought, I got to get out of here. It's a little too, I don't know, insular, a little too distant. And I wound up working in Southern California. I worked for the Orange County Register, and then I worked for the LA Times. And the Register is when I really started working personal finance as a beat full time. And I had a couple of really great editors, but a lot of times I couldn't understand what they were talking to me about. So I wound up getting the CFP education, the Certified Financial Planner education. And back then, they didn't allow journalists to have the mark. You had to be a practicing financial planner. So I didn't bother with the test. Well, fast forward 20 years, and they are giving the mark to journalists. And so now I decide that I'm going to go get that certification. And so I wound up having to basically uh, study, like I did this boot camp thing to try to make up for the 20 years that had passed
Right.
since I actually took the classes. And by hook or by crook, I passed the test. I got the certification, which I still have. So the bottom line is, I worked for the LA Times, then I went to MSN and I wrote online, and I rounded my career out by working for NerdWallet, personal finance site. And I just got really, really lucky. I was in the right place at the right time so many times over and over. I had so many people who gave me a hand up, gave me a job, gave me a better job. And I worked at a lot of these places when they were absolutely at their peak and got out before, got out just in time sometimes. So,
So LA Times, NerdWallet, um, what are the other places?
oh, well, I was at the LA Times and then I went to MSN. So I wrote for Microsoft's big online site. And I did that for many, many years. And that's where I wrote my books. So my first book was Your Credit Score. I think it came out in 2005, something around there. Went through 5 editions. And then I wrote other books all about money.
Okay.
And then in 2016 is when I went to NerdWallet and I worked there for 8 years.
Okay. And how does NerdWallet differ from, what was the NerdWallet experience? How does that differ from like writing for the LA Times?
Yeah, it's not a journalism site per se. It's a personal finance site. So they started out as a credit card comparison site. A lot of people, that's how they were first introduced. They were looking for a credit card, and NerdWallet helps you shop for those. And it has since expanded into all areas of personal finance. I wrote a column that was picked up by the Associated Press. So my job was very much the same as it was for the LA Times. I was writing for a big general audience. And it was a great experience because NerdWallet itself was this scrappy little startup at the time. It's since gone public. It's since much bigger, but it's still a great place to go to get personal finance products and get information because it tries to be objective. It tries to help people connect with the right products for them, rather than I don't know, shilling products that aren't a good fit.
That's great to hear. I don't know too much about NerdWallet. Uh, so, and you've written how many books now?
5 books altogether.
5 books. And it's mostly about getting credit, or is it more credit oriented, or?
The first one was about credit. The others were, one was about debt, deal with your debt. The last one I wrote was the 10 Commandments of Money. So it was very general personal finance book.
Uh-huh. You can't remember any of the commandments at this point?
Probably not.
Yeah. So are people, I mean, we have a national saving rate that's just down the tubes. Back in 1950, in the 50s and the 60s, if you look at national saving, so you look at national income, which is GDP minus depreciation, so it's like net national product minus something called indirect business. Anyway, you measure it correctly. You can do this in the national income accounts, you can do it online, and you subtract off uh, government consumption and household consumption. So you take away all the consumption out of the income, the net income that the country is producing, and you divide by the net income. That saving rate was 13% in the 50s and 60s. It's gone downhill to 3%. Now, a lot of this has to do with government policy. In my view, we've been systematically taking from young people and giving to old people through a variety of what I call Ponzi schemes, which is a strong lingo. It sounds like a right winger, which I'm not. But when you take money from young people to pay old people their more Social Security benefits, that started really, Eisenhower doubled the size of this program, for example. It's not just Democrats, but Republicans. Nixon double indexed Social Security. And we now have a $63 trillion unfunded liability in Social Security because we have promised baby boomers and people behind them and people in front of them, time-wise, all these benefits, which we don't have enough taxes to cover, and because of the demographics too. So the aging. So we have a Ponzi scheme that's running out of people to sell the chain letter to. So that's part of what's going on. But there's also if I look at my economic colleagues in my department, we have 35 really super top economists. And I've developed this financial planning software tool called Maxify Planner. It does economics-based planning. So all these people intuitively know how you should be planning if you're what economics says to do when it comes to financial planning. The tool's available through Boston University to all employees. Out of the 35, I think 5 people are using it. Okay. And the ones who use, like the most recent person is using it, he's in his early 60s, finally thinking about retiring. And he said, I just started using I've been using your program, and it's just fantastic, and it's incredibly valuable. He's been with me for 25 years as a colleague. I hired him. And every year he gets the notices about the software. And I said, well, Dilip, how long have you been using this? About a year. And so something kept him and is keeping other people from, doing this, even though there's all kinds of free money to be made here. You can optimize your social. It's called Maxify because you can make bigger your Social Security benefits, lower your future taxes. We just came out with a Roth conversion tool. It's using very advanced. These are very difficult calculations that people can't make, and Wall Street certainly can't make with the techniques that they've got. And we can get it right to the dollar, how much to convert every year, and what it's going to mean in terms of savings. And it's really turning out to be as big a deal as Social Security. But will they use it? Probably not. And I'm just wondering where you think that psychological barrier is coming from.
Oh, well, there are a lot of different ones that are in play here. And one is that DIY instinct is really strong in a lot of people, and is particularly my generation and older, because it was really difficult back in the day to find anybody willing to give you advice that wasn't earning a commission. So people who are wealthy, really didn't have a problem finding fiduciary financial advisors, the ones that would put their interests first. The ones with less money, not so much. Now, today, we have a much better setup. We have many more people who are willing to charge by the hour, to charge retainer fees, to take on people that don't have a lot of assets. But back in the day, not so much. So a lot of people got into that DIY thing. The problem as they approach retirement is that they've never been through it. They don't know what they don't know. They don't know the questions to ask. And so they make mistakes. As you've seen, they start Social Security too early. How many people have come to you with spreadsheets saying, oh, it shows I should start when I'm 62? It's just ridiculous. They don't even know the questions to ask or how to look at this or look at tax rates or look at fiber benefits. They don't think about any of that. So I can go off on quite a rant there, but I think a real significant barrier is people need the hand-holding, the face-to-face connection. And I used to blow that off as any reasonably intelligent person could handle their own finances. And then after I went through the CFP training, I hired an insurance broker. I hired a tax pro. I hired an estate planner. Eventually, I got a financial planner of my own. There's simply no way to stay on top of all of this. And there is nothing like having somebody to turn to and say, is this a good idea? Can I do this now? Will this make sense? What are the repercussions down the road? And your software is incredibly burly. A lot of people just can't interpret what they get. They need that human being to help walk them through it. So if there's anything I would say, if you are approaching retirement, if you're within 5-10 years, find yourself a financial advisor. Find somebody who's fee only, who's fiduciary, who can walk you through it, because there are so many decisions you make around this time that can be irreversible and can cause you to run out of money too fast. And so I think there are people that can handle all of it themselves. Even them, I would say, just get a second opinion. Cost you a little money, but then you've got that backup that you're on the right path.
I have a lot of financial advisors who actually ask me to say the company they're working for forces them to use this tool, but they've been secretly for themselves been using our tool. And I don't think it's all that, it just says here, hey, put in the same information you tell anybody else, like how much you're earning, what your pension, your retirement account contributions are, that kind of stuff. And then it just immediately says, here's how much you can spend on a sustainable basis. And here's how much life insurance to buy. Here's how much to save. And by the way, if you click this button, you can start raising things, figure out the best strategy for Social Security or versions, or when to start your withdrawals to lower your taxes.
But Larry, you're an economist. You are, PhD level education. I'm not PhD level, but I'm up there. And sometimes, there are a lot of people that basically have a functional high school education, and it's going to be tough for them to interpret all that.
See, it's they want to have handholding. Even so, if I went, I'm thinking about doing this to my faculty members and said, I'm going to help each one of you who are not using the program yourself, and let's see, I'm going to just do as an experiment to see how many people come and have meetings with me. I'm going to offer to set up a time and have meetings and see if I can get them going. That would be interesting, because that's it's showing you there's a psychological barrier or confidence barrier, because these people are brilliant enough to and they've used computers all the time and software to figure out this tool. It's like just simple accounting, really, and they don't need to know how the algorithm works to see that it does work. It's like stepping on the Porsche gas pedal. You're in a Porsche.
Well, at NerdWell that we did a lot of user testing, and that sometimes can blow you out of the water of what people assume, how people use a product. It can be totally different from how you expect. So I think that could be really interesting if you did that. I'll bet you find out a lot.
See what? Yeah, that's my. So we are kind of moving into the idea of even to the point of saying, look, if you don't want to touch our software, we'll do it entirely for you. We'll plan for you. And we have a lot of advisors doing planning with the software, but we do have tens of thousands of households doing it themselves. So it's not like everybody is stuck. When we have people that don't have too much background in, and so it is really a very heterogeneous response to the situation. I'm wondering whether the general trend here of not planning is reflecting the notion that the government and your employer together, if you're upper income, and even these people are as a group are under saving and making mistakes on Social Security, whether they're thinking, well, Social Security and my employer surely are taking care of me. I don't need to do anything else. I can wait. We've got could be a plan at Boston University. It must be enough. Social Security is going to give me a floor, but it's not enough. And then people retire, and then if they do go to a conventional financial advisor, the software there is calculating the value of taking your Social Security benefits early or later with the wrong valuation method, with a method that assumes that you're kind of like in Groundhog Day and you're going to be dying,
repeating the same,
replicating and dying at all these different dates. So they're using actual calculations. What's the probability that I'm going to live to this age times the benefit, and I'll discount it. What's the probability I'll live to the next age? And of course, that's completely inappropriate according to economics because you're only going to die once. You can't put the averages. It's just like with homeowners insurance. You can't count on your having the average size fire. You have to look at the catastrophic risk. The worst case scenario here is living to 100, to your maximum age of life, so you can't count on dying on time. But nonetheless, Peter Coy from the New York Times, who you must know, is writing a little more about personal finance. 2 days ago, he wrote a column about people taking Social Security too early.
Yeah.
And he had like 20 immediate email questions, and he asked me to help kind of sort out the answers. And so I spent a couple hours last night doing that. And all the questions were all about probability. I've used this tool, and this tool says to take your money early. And what they don't realize, is the analogy with other kinds of insurance, that nobody would ever think about insurance in this way, that I'm going to have the average loss. But they also don't realize that all the tools that are out there are geared to getting people to take Social Security early. It's not innocent, because then the advisors, then Wall Street can tell you to keep your money with them, with the money managers, and that leads to more fees over time if they can retain assets under management. So none of these financial companies are providing proper advice about collection. Let's talk about retirement for a minute. It's something Americans think about regularly. Ask yourself, how financially secure do you really feel? Do you have enough money to retire? How much is really enough? And if you don't have enough money, how can you possibly find that extra money before you do retire? These are all tough questions. My retirement software, Maxify Planner, is the powerful online planning tool that takes the guesswork out of retirement. It weighs your assets against your fixed expenses to calculate how much you can safely spend every year for the rest of your life based on when you decide to retire. And it shows you safe ways to find more money. Maxify makes a complicated problem like retirement planning simple. It's accurate, easy to use, and produces what you really seek, peace of mind. So make the smart choice and visit Maxify.com today. Don't miss this opportunity. That's Maxify with an I, M-A-X-I-F-I, Maxify.com. Now let's get back to the podcast.
I would be very suspicious of accepting advice about claiming strategies outside the world of fee-only financial advisors. I think the word has passed among fee-only financial advisors. They know that delay is almost always the best option. So I think there's, because they understand how survivor benefits work. They understand about catastrophic risk. And what we always say about insurance is it's meant to protect you against the loss you couldn't sustain on your own. And insurance is in the damn name of Social Security, the old age, whatever. Insurance is right there. So getting people to change their mindset to realize that's what it's for. It's for, insuring you against the risk of running out of money. And I've struggled with how to communicate this with people. And I think I finally got it because somebody asked me about this recently. And I will say I'm getting fewer questions that are insisting that taking it early is better. But in this particular one, I said, you know what? If you guess wrong and you die young, you won't care. You won't care about the money you left on the table, but your spouse will. They'll care a lot about the fact that you waited long enough to build up that survivor benefit that they have to live on for the rest of their life. So I do think there's,
Yeah, that you didn't live long enough. Yeah.
yeah, yeah. And you know, people get so focused on that break-even age, and it's like if they even bring up break-even age, they're talking about the wrong thing. They're asking about the wrong thing.
That's
Are
right.
you married? If you're not married, you know, how are the rest of your resources? If you make this decision wrong, how are you going to, you know, insure against outliving your
Pretty
funds?
well-educated questioner. You know, people reading Peter's very high quality columnist and one of the best, maybe the best writer about economic research because he really reads the papers in full and talks to economists all over the country about all kinds of issues. Uh, so we had a very good readership, and they're writing about break-even age, as you're saying. But then the other thing Peter said is somebody sent him a link to a Social Security website, you know, one of the pages of the website about how you decide when to take your benefits. And it says right there that Social Security, you know, the paragraph started out by saying you should calculate your present expected value of benefits using your mortality probability, your survivor probability. So this is like first order stupid, which is what I wrote back to Peter. And I sat down literally 20 years ago with Steve Goss, who's now the chief actuary for Social Security. And I had to, you know, he's an actuary, and he wasn't really thinking about the way about this as insurance. He was just thinking about it as an investment,
Yeah.
which it's not. And so we have the largest insurance company in the world saying basically, don't buy my product.
Yeah.
If you wait for, you know, from 62 to 70, you're going to have a 76% higher benefit adjusted for inflation. And the benefits you give up are in effect the premium for this higher 76% higher number.
Yeah.
So are buying annuity, longevity insurance that way. So they are in effect selling insurance. And so Steve eventually by the end of lunch, and I was saying things like you are about you can't count on dying on time, and you know you're gonna have all the money in the world in whatever currency you want when you're in heaven. You're not going to be kicking yourself in heaven for not having taken your money too early. So he got it, but he hasn't been able, I guess, to get this stuff changed. And we have
Yeah.
so many things on this that Social Security is telling people that are misleading. One of my other
Yes.
enormously pet peeves with Social Security is about the earnings test, which is telling people almost everybody is taking their benefit before full retirement age, and most are taking it before 65. So this January, unless I can get the commissioner to change this, I'm going to try by writing a column about this and sending it right to him. I now have access through my friend Janet Yellen, who's the Treasury Secretary, to make sure that he sees things I write that I want him to see. So he's a terrific guy, but he's not an economist. And we have this letter that goes out about the COLA every year, every December. And it says in the first page, you know, you get this kind of three-part thing that's pasted together. The top page tells you about the COLA. And then the second page at the top talks about the earnings test. If you earn more than this year, it's $22,320.
Money. Mm-hmm.
You're going to lose 50 cents on the dollar of your benefits due to the earnings test. Not a single word about the fact that when you reach retirement age, they have this thing called the adjustment of the reduction factor, which gives you an increase in your benefit, the benefit that you lost due to the earnings test. It gives you all that money back plus interest plus mortality. So actually gives you back $1.20 for every dollar, the way you should actually do the accounting. So it's a great thing to lose benefits due to the earnings test. So a lot of people would presumably have been fired or because of ageism, not retained, or kind of induced to leave at 62, and then they find that they really can't afford it. They take Social Security early because they have no other money, not enough money,
Yeah.
and they're worried about not making it on the losing out on the stock market's increase, and then they're sitting there thinking, "Gee, if I go back to work, I have this offer, and I'm going to lose 80% of my benefits through the earnings test. I'm going to lose being the 25% tax, whatever bracket, 24% tax bracket, federal bracket, and then I'm going to lose state income taxes. It just doesn't pay. I'm going to just be working for the government, a government." And that's not at all true, because
Yeah.
this is actually, but this has been conveyed to the public for decades. I mean, the earnings test was part of the original legislation. And have you, and if I ask people, even financial planners, do you know about the adjustment of the reduction factor? No, never heard of it. And a lot of them have never heard even about the earnings test. So we have like
Well, tend to be dealing with high net worth individuals. And there's a couple things about that. One is that those folks have less to lose if they make a mistake.
Right.
And a lot of them are already focused on delaying as long as possible, because the one thing you can't get back if you do start early is the increases that you would have gotten by waiting, and the delayed retirement credits and all that. So I totally get your point. And I've actually talked to readers about exactly that the money will be coming back if you do have to give up some earnings to the earnings test. But my understanding is that in most cases, it would still be better to wait if you can. And a lot of people can't. A lot of people, they're just taking the money because that's what they need to live on. So
Even though they could be cashing out the retirement account and holding on. I say people should beg, steal, and borrow to not take it too early, but it's not true for everybody. I mean, some people should take it early. If you have if you're single and you have a pancreatic cancer, obviously you take it immediately. But if you're a spouse and the spouse is a high earner spouse, she's never going to collect a widow's benefit off your record, you take it early. But if it's a low earning spouse and she's going to collect your benefit, you wait till 70. And the information from Social Security is just so bad. I'll just tell you one anecdote or story, true story. I was at a dinner party, and a doctor came up to me. Somehow he knew about my work on Social Security, and he said, "Lovely guy, top doc." He said he'd just been diagnosed a month ago with a pancreatic cancer, and he said that he went to Social Security and they told him to take his benefit immediately. He's 68. And I said, I see, I've met your wife. Did she have a significant earnings record? No, she never worked. And I said, well, what you want to do is go back to the office and withdraw your application, pay back the 1 month check, because the widow's benefit is going to be 16% higher. So your wife can get that for the rest of her life if you wait for 2 years to collect at 70. And even if you pass away at 70, this is the thing to do. And he did do that, but the people at Social Security are just not.
We ran into that. Can't remember if we talked about this, but my husband is 10 years older than I am, and we had a minor child at the time. So when he hit full retirement age, we started benefits because we used your software and we talked to our financial planner and got the child benefit for a year and a half, I think it wound up being. And then when she aged out, we went back to the Social Security case. Okay, now we want to suspend our benefit. You can't do that. It's like, yes, we can do that. So we tried that thing where you hang up and you call again. We got the same response. You cannot suspend your benefit. My husband was already full retirement age. It was just ridiculous. So I think it took the third person that were finally knew that, yes, we can do this. And we were even pointing them to the page on the Social Security website that says, yes, you can suspend your benefits at this point. So I know it's complicated. I know that they don't have enough people that have, the depth of information. But, we got to keep telling people, don't assume that what Social Security tells you is true. Get a second opinion from somebody who knows what they're talking about.
Yeah. What about Bitcoin? Let's talk, I think what we're doing is evolving into talking about specific issues that we see out, specific behaviors. What about Bitcoin? I was just talking to a 33-year-old guy who is here at BU working as a staff member, and he's telling me he's made a killing in Bitcoin. And I, of course, sat him down and explained he needed to sell it and buy inflation index bonds, which have a very high yield right now, or even just put in the S&P. And, there's some great reluctance because I think he feels like it's cool to be in Bitcoin. And maybe this is part of what he wants to talk about on his whatever, I forget the name of the dating site.
Tinder
dates.
or Hinge or something. Yeah.
Tinder dates. I got booted off of Forbes. I was writing for like 20 years for Forbes, 15,
I
20.
remember. Yeah.
And I got booted off of Forbes because I wrote a column about Bitcoin being a dominated asset. And in economics, we generally say don't put all your eggs in one basket, which means
Right.
it kind of suggests that you should have all the eggs that are out there should be in your basket. Okay. But if one egg is rotten compared to the other egg that's doing the same, so that basically in all states that bad egg performs poorly compared to the good egg, that's a dominated asset and you don't want to get near it. And I wrote that Bitcoin was a dominated asset because nobody had actually kind of expressed it that way, because everybody still had this idea that a little bit of everything is somehow better. And then I got a call from the editor who had just been hired, who said, you're not authorized to write about Bitcoin. Hadn't you read your emails? And I said, no, I don't read the emails from you guys. You sent too many. He said, well, and you've been hawking your software too much. And I said, well, I have to write about, I have to talk about something specific. I want to put numbers in. The numbers are coming from here. I got to say where the numbers are coming from. Well, I said, well, you've been warned a couple of times on that. Now you've crossed this line, and maybe you should find a different place to write for. And this is after answering about 10,000 Social Security questions for free, literally that many, because we were doing it 3 days a week for years. It was like, because it was a new editor and he backed him up. But I think it might be that really what was going on here is that they wanted to check out, they only wanted to have a few set of people writing about Bitcoin who were positive about Bitcoin because they had advertisers who were in the cryptocurrency. This is the only thing I can consider, I think about. But anyway, at that point.
Well, there's also, there might be, because I know we ran into this at NerdWallet, if we so much as mentioned certain investments or certain investment, even retirement funds, it sometimes had to go through compliance. So that could be another layer to this.
I never use that. And maybe I was implicitly giving, or I was giving investment advice, and maybe, but he never put it that way, which fair enough. So maybe I'll take back that maybe they had no financial incentive about this. So my bad. But anyway, do you think the whole Bitcoin phenomenon is psychological here? Young people trying to.
Oh yeah, I think that there's definitely part of that. And then there's the age-old difficulty of letting go something that's been a winning asset. Right. Especially if it's been recently, the recency bias, if it's been recently doing well. And I say this as somebody who's
taxes, yeah, too.
Well, and that's, that kind of trapped my father-in-law with his investments. He was really, really reluctant to sell. And he bought, I'll just throw out some numbers. I'm not even sure they're accurate, but say he spent $13,000 on Microsoft shares and they were worth $1 million. I mean, he had a couple of hits like that. And it's, really, really tough to take some of your winnings, to sell your winners and buy your losers, which is what, asset allocation tells you to do, responsible asset allocation. So I don't think we're going to convince people not to invest and whatever is the hot new thing, or even the hot, no, not so new thing. I do think blockchain technology is really interesting. And I think there's a lot of different ways to invest in that. It doesn't have to be just Bitcoin. I think the only thing we can say is moderation. Don't overdo anything. It can feel like this is a winning thing. I want to go all in. And that is just so, speculative investments are speculative. You can lose everything. So you got to be careful about how much money you put in something that can go to zero.
Yeah, and you can't really fall in love with your assets, your portfolio, because your portfolio doesn't love you.
Yes,
Your portfolio
exactly. And
basically,
people do get emotional about this stuff, right? They'll inherit shares from their beloved father or a stockbroker from their beloved father and not be able to get rid of either one. It's an odd thing, our relationship with money.
yeah, it is, and I don't know where that's coming from exactly. Why? Maybe we need to, we've done well. There is a cost to getting out of it, but clearly, if something like Microsoft or Google or any of these things that have done sensationally well, NVIDIA, there's going to be a limit, and basically, there's a bandwagon effect because we don't have rational investors here. They're really basing their decisions on looking at annual reports and really studying the economy. I don't think any economist would have. Most economists know enough. They've been hammered in school to know enough not to do this, to know be separate, to think, not to be personally connected to their assets. And so I think maybe what people should do for practice to heal themselves here is to look at their portfolio and everything that's done well, sell it. And just to get into the habit of getting out of stuff. And then, once you do that 10 times, now the hold that stuff has on you, it's kind of the addiction seems to dissipate. I think, and I just did a piece. So I'm writing LarryKotlikoff.substack.com, and you're still writing your Ask Liz column, right?
Yeah, it runs in the LA Times and on my site and a few other papers.
Okay. How many times this comes out once a week or?
Once a week, yeah. AskLizWeston.com.
So you're answering questions, I guess, right?
Mm-hmm.
Okay. So yeah, my Substack, I writing about a whole variety of different things, and so what are you finding are questions that are coming into your door?
Well, honestly, Larry, since I started writing about Social Security, 80% of the questions I get have something to do with the program, which reminds me back in the day of when I started writing about credit scores, because I started that around the turn of the century. And there wasn't a lot that was publicly known about credit scores. They were still supposed to be secret. So back then, again, 80% of my questions were about that one topic. So I could write just about Social Security and nothing else, but that's not so interesting. I want a broader column.
Yeah,
so I do try to.
Yeah.
I'm sorry?
Like an endless interest in this, which is
Yeah.
remarkable.
Yeah, really. Well, again, we know the program is so ridiculously complicated, and people think they understand it and they get it wrong. And one thing we haven't talked about is this conviction that the program is going away. It's like going to disappear when the trust fund goes dry.
Right.
And the fact that they are going to be or should be collecting enough in taxes to pay 75% or something of the promised benefits kind of goes out the window. And I think that also encourages people to grab the money now because they literally think the program's going away. So it's all I feel like I do have to keep answering the questions about Social Security because it's so important, and getting the correct information out there is so important. But I mean, there's a lot of other things that people have questions about, from investments, budgeting, credit, taxes, there's insurance, there's just a lot of stuff out there.
I'd like to talk to you about a really powerful financial planning tool to help you make smart retirement and other critical financial decisions. It's a tool that factors in all your financial data and shows you what you can sustainably spend every year for the rest of your life. That tool is my software company's Maxify Planner. It's incredibly powerful, it's accurate, and it's easy to use. Maxify takes the guesswork out of financial decisions at every stage of life. Its focus is on raising, de-risking, and sustaining your living standard. Maxify lets you run what-if scenarios to see how your finances will change in taking new jobs, buying a home, doing Roth conversions, retiring early, downsizing, investing more in the market, you name it. Knowing the impact of these decisions before you make them is the secret to making smarter decisions. And it's also the secret to what we all seek, which is financial peace of mind. So please visit Maxify.com today to start planning. That's Maxify with an I, Maxify.com, Maxify.com. Now let's get back to the podcast. Yeah, the possibility that, I mean, President Trump is talking about not taxing benefits. That would mean in 2031, a 33% cut in benefits, according to, I think, the CBO or some, I think maybe the Tax Foundation did a calculation. I think as it is, we're going to be at 2033. There's supposed to be a 21% cut in benefits. For that to happen, I think there would have to be, people would be committing political suicide because the elderly are being catered to because they have nothing better to do on election day than to vote.
Yep. That third rail thing.
You know, another thing that people are doing is finding advisors who they trust. There are 300,000 advisors to run their money, because that's kind of what happens with this conventional financial planning. They set a target too high, then they run the Monte Carlo, say, well, the way you're investing and the way how much you've saved, you're investing conservatively, you haven't saved enough. True. And we've set your target for spending too high, you'll never meet it. Therefore, invest with us. Now your probability of making your target is 87%. And everybody at that point folds and says, here's my money, run it, let me run your money. And they're also, you know, very attractive, kind of reassuring people. Well, it's not a, you know, they're probably taller on average, more attractive on average. People on Wall Street, you know, when you see somebody who's tall, thin, and an attractive male, that he's going to be an investment banker. And sure enough, he's going to school for investment banking. And I've seen a whole lot of them, and they all look the same. And there are people that, you know, somebody would, you know, say, I wish I could be them. And therefore they're making it, and therefore I can make it, they can help me make it. But of course they charge for their advice. But then I did write a piece in Substack a couple of weeks ago based on some work there that Weston Sloak from Apollo, he's the chief economist. It's I guess it's an investment company leading one. He's a brilliant economist, and he keeps coming up with these pieces of information that we should be paying attention to. So this one was an SEP. He went through the S&P, some studies about how much of equity fund managers, what fraction of them were beating the market. Turns out that 90% have been underperforming the market.
Yeah.
And of course, charging for the privilege. So that's another thing that people need to realize, that Wall Street is not your friend. And these very good looking people and very convincing and friendly, reassuring people are not your friend when it comes to your future self and taking care of yourself. And that you shouldn't be investing with your cousin. You know, cousin goes.
Yeah, there's still a lot of confusion about fee only versus fee based, for example. And the wirehouse guys, you know, they are not fee only. They're making commissions. They've got all kinds of arrangements, and this is something that hasn't changed in the 30 some years I've been writing about it. The fee only options have only increased, but people get confused and they assume because the guy is nice and he's personable and I like him, he must be putting my interests first. And that could not be further from the truth. They're held to a much lower suitability standard. They can sell you investments that are poorly performing or more expensive than the available alternatives. And that's legal. That's fine. So that's why I keep, again, banging the drum for fee only. That fee only, they're only compensated by fees from their clients. And I will say, I hate the AUM model, but that's what I'm under with my financial planner, because some of the best financial planners, that's the way they do it. I think, and AUM, for the people who don't know, it's assets under management, charging a percentage.
So
And to me, that's monetizing the wrong thing. They are monetizing what should be the commodity, which is investment management, and giving away the advice for free. But I found a financial planner I like. That's the way they do things. So, but if you're out there looking for a financial planner, you can do fee only by the hour. You can do fee only by retainer. And that puts, I think, the emphasis where it should be in paying for the advice. And, you know, a computer can handle your investments, but the hand holding that we're talking about, the having that person that you trust and can trust to turn to, you know, that's, to me, that's worth searching for and worth finding the right person.
So to me, what I'd like to do is be your financial educator for free. I'd like to, I'd like, I'd like you to, I'd like to save you the commissions and just have you, just run you through our software, hold your hand, because I think we all could use that. And my software holds my hand.
Yeah.
And that's the thing about it. The but I mean, I have a relative who this, you know, she lost her job, changed, so she became unemployed. She's in her 60s and brilliant. She'll probably get another job right away, but meanwhile, she took the opportunity to try and understand this, you know, situation. I'm saying she's actually a he, to tell you the truth. And the situation is that he's in good financial shape, but he was invested with one of these big investment companies, and he sent me the investments that he was holding. They were about, you know, it was like $1 million portfolio, 40 different mutual funds, stock funds, bond funds, all variety of funds. Now, and then the charge was 1%. So it's $10,000 a year. And this is money that they could be using for something else, including helping their kids, you know, who they love dearly and are helping, but this can make it easier for everybody. So I said, look, 40 of these things, they all have low, you know, not only do they have is the whole, you know, the fee for managing this stuff, but there's also loads. And then we talked about the loads, and they're all doing essentially the same thing. I mean, it's not any different than holding the S&P. And you could hold the S&P at 3 basis points, 3% of 1 percentage point, not 100 basis points, but 3 basis points with Vanguard, for example. I don't have any connection to Vanguard, by the way. But they have this VTSAX, which is the entire stock market. 3 basis points, and I'm sure Fidelity and T. Rowe Price and other companies have the same thing. But the advisor was putting them into this, and the advisor was someone they'd been using for years, and they trusted the advisor. Well, you know, it's impossible for that kind of a portfolio to outperform the S&P because it's the same thing.
Yeah.
The only thing the only thing that it did was lose money during this 23% cumulative inflation we've had over the last 5 years because they were nominal bonds as opposed to TIPS. TIPS are now yielding 2.27%, I think, as of this morning, real 30-year TIPS. And so a portfolio of stocks and the whole market and TIPS at no cost is bound to save you money over investing with someone, but 90% of these people are losing money relative to the market.
Mhm.
So this is a real, and then they move the money out of away from that advisor, this guy and his wife, and put it with another company. And they said they met with this person. He seemed really great. This is a very educated family, and both have upper level degrees beyond their BAs. Seemed really trustworthy and liked him. And what was he going to invest them in? And it was the same kind of story, a little bit, lower fee, but still ridiculous. And all on the basis of having a meeting and trusting somebody based on the meeting. I don't get this.
Well, it can make sense if you are getting full comprehensive financial planning. If it's not just investment management, to me, I agree. It's not worth it.
They were using our software, so they already had and they just had to run the investment part of the software. They couldn't trust themselves to run, even though they were running the rest of the software, the deterministic planning, where let's conservatively assume you're going to earn the TIPS return, the TIPS term structure, basically. They couldn't bring themselves, when it comes to investing, to take control. But economists are telling you, and you're telling everybody, there is a way to take control. Just do this. You don't have to be trusting somebody you've never really met, or who has no obligation to you, but you can just the stocks and TIPS. And if you just spend out of the TIPS and let the stocks ride, you won't have what's called sequence of return risk, which you're about. And then you'll just have upside to your living standard, because when you spend out of the stocks, it's after you convert the stocks into TIPS. That's a plan that our software handles. That's called upside investing. There's no downside risk. This is what most American households should be doing, upside investing, because it's the way to have some play in the market, but not put your basic living standard at risk. That's a way to kind of sleep at night without having to trust somebody you don't really know. And that advisor can't beat the market. I mean, he's not. Warren Buffett is even lost in. If you look at the last 15 years, he's underperformed the market, I think.
Yeah.
What I was Googling.
Well, and that's, when I was saying that the focus for AUM is on investment management, and that's not where the focus should be. And people get confused about this all the time. They ask, well, why should I hire a financial planner? Because they can't beat the market. It's like, that's not what comprehensive financial planning is about. It's about the rest of your financial life. Investment management is a commodity. You do not need to pay somebody for that. But it can be very helpful, especially the more money you have, the more complicated situations you're in. It's so helpful to have somebody to help you with the estate planning, the insurance, the taxes, the legacy strategy, how you're passing money on to your kids, the college planning, all this other stuff that can be part of it. And that, to me, is worth paying for, not the investment management. And if somebody's telling you that they could beat the market, that's a good reason to run away, because they can't. Or if they do, it's going to be like kind of a one-off thing. It's not going to be something they can consistently do. It just doesn't happen. Larry, this has been really fun. I actually have a hard out at 12, so I got a boogie, but I've really enjoyed talking with you, and I'm glad we finally got a chance to do this.
Yeah, this is great. I think we've got to hit a lot of topics, and I think this will be very helpful. So thanks so much.
Me too.
We'll keep in
Thanks
touch.
for the invitation. Talk to you soon.
Bye-bye.
Bye-bye.